Downturn in the benchmarks continue for the second day on a weak global cues. The bearish sentiment further supported by a mixed December quarter performance by Nifty majors. Meanwhile, mid-cap and small-cap indices decline but outperform benchmarks. Nifty Bank crashes over 2%. Tech stocks buzz and buck in trend. A dismal day of trade for HDFC Bank. The stock plunges over 5% post Q3 earnings, losing over 82,000 crores worth of market capitalization in a single day. And on our radar today, Asian Paints and ICICI Prudential are set to report their December quarter earnings. Stock trades flat ahead of Q3. Today on NDTV Profit, we get you top voices from the World Economic Forum Davos, where top economists and corporations are speaking about the changing landscape of the business world and global economy. Hello and welcome. This is the F&O Show. I am Agam Vakil, and in this show we take you through all that is happening in the futures and options space in Indian equity markets. For now, markets under pressure. The large part of that is on account of weakness in India's largest bank, HDFC Bank, which is also buckling under its quarterly earnings coming through. There hasn't been as much of a bad when it comes to its quarterly earnings, but the stock has taken a big knock of around 5% as we speak, and that's, of course, weighed on sentiment on markets across. So when you consider the bank, the Nifty specifically, let's pull up the constituents and take a look at what kind of contribution the bank Nifty is weighing on as far as HDFC Bank is concerned. And, well, the chunk of it, isn't it? That's where you see a large amount of that correction as far as HDFC Bank is concerned. And while you do have names like TCS and Infosys who are trying to do whatever they can to keep some amount of the correction in check, there is a large amount of pressure when it comes to that large bank. But even when it comes to your broader markets, well, they are under pressure at the moment. We are seeing weakness in the mid-cap and the small-cap indices, but they're outperforming to a certain extent, but just by a tad bit when you compare them to the Nifty. Let's take a look at what's happening in the Nifty futures. Now, that's where you are seeing a lot of positions being built towards the short side. Do remember that when you consider the Nifty, it has come off. So there's unwinding coming through as well from earlier long positions made. And that's where we see a decline of around 1.7% in open interest. The Bank Nifty futures, on the other hand, looking at a huge increase in open interest of nearly 13.5%, even as the index declines by around 2.5%. So shorts certainly into the system, and the Bank Nifty well away from that crucial 48,000 mark. In fact, 1,000 points away from there at the moment as we speak. In fact, the underlying has lost out on even the 47,000 mark. So we'll be keeping a close eye on that particular level. As far as your options market go, until yesterday when it came to the Nifty, we were looking at a range of 22,000 on the lower end and 22,500 on the higher end. And, because of that, a lot has changed now as we go into tomorrow's weekly options expiry for the Nifty. Let's pull up the open interest distribution, and that will perhaps give us an idea about where the range has now shifted towards. And naturally, considering we've seen so much unwinding around the 22,000 put, well, naturally, we'll start seeing a little more traction around 21,700, 21,800. So those are the levels that we are watching out for as far as the Nifty is concerned. Let's move on and get in our experts for today who can perhaps help us further in deciphering this data as well as placing bets going forward. We have Dhwani Patel, founder of Finversify, and Ajit Mishra. He's the SVP of Research Religare, who's joining us on the show. Good morning to both of you. Dhwani, I'll start with you. Your view on the benchmarks now that we have seen the HDFC effect play out. How are you approaching the major indices?
Good morning, Agam. Definitely, there is weakness that we are witnessing on the index right now. Both the index, Nifty and Bank Nifty, are being hit by the results of HDFC, and we are seeing a good amount of profit booking coming over here in both the indices. On Nifty, particularly, what I'm seeing over here is 21,800 now becomes a very crucial level, 21,800 to 850 for it to breach for further bullish sides of trade. I'm seeing more profit taking coming in over here on the both the indices. For Nifty, particularly, the level that you need to next watch out for is 21,675. Once that is taken out in the intraday, I would be looking at bearish sides of trade. The next target that come up over here on this particular index is 21,480. So these two levels are very necessary. 21,800 on the higher side, 850 on the higher side. Till that time, it's not taken out. I go bearish on Nifty right now. Bank Nifty as well. We did see that in the first half we had some recovery coming in, but that did not sustain the entire time. And from there, we are constantly seeing coming up on the Bank Nifty as well. The next level on Bank Nifty that you need to watch out for is 46,600 mark. If we breach the 46,600 mark, 46,000 is the next number that I'm looking up on Bank Nifty as well.
Okay, so that's as far as the Nifty and the Bank Nifty are concerned. Certainly a lot of caution for those who are longs in the markets. That's the word coming in from Dhwani Patel. Ajit, I'll come to you on the benchmarks as well. How are you assessing these trends now?
Yeah, good morning, Agam. So, Agam, a couple of things. That till yesterday, we was just seeing a pause after 4 days of advance. And today, with the kind of cut that we are seeing, plus now the follow-up move that we are seeing in the index after the initial decline. This indicates that the momentum that we were seeing in the market, that has faded away. And because we have re-entered into the zone 21,800 to 28,500 that we were trading it earlier, and we witnessed a breakout, and we made a high around 125. So with this, now we feel that it's more of like consolidation again that might set in with a bias on the negative side. And since we are still holding above the 20 EMA, so the overall trend has not changed yet when it comes to the index. So 21,570 is the area basically where we have 20 EMA placed. So that area like there's a strong support. But yes, intraday, the way we are seeing selling pressure emerging at the higher levels, any rebounds toward 21,850 could be the zone where one can look for fresh shorts, intraday shorts with 920 as a stop and 21,650 to 600 being the target area. Similarly, for the banking index also, we feel that after the decline in SDFC, it's contributing roughly around 170 points in the overall decline in the index. So this close is going to be critical. If we close below 1600 mark in SDFC, then expect this pressure to extend further in banking index as well. As of now, 46,900 is what we are eyeing as a make or break level. A close below that would trigger further decline towards 46,600 to 46,300. 46,300 is something that we are eyeing as a crucial support now.
It does now look like there's further precipitation, and it seems like 47,000 is in the rear view mirror, at least a bit, because we've seen a sharp cut in the last 5 minutes on the Bank Nifty. As we speak now, it is currently at around 46,700 and it's now down around 3%. So we are seeing a lot of selling pressure, and that's coming in on account in the last 5 minutes. So keep an eye on some of these levels, because this certainly does have a bearing on the entire sentiment of the markets. Well, needless to say, to both our experts, I want to talk about HDFC Bank. Ajit, your view now is, at least technically and based on the derivatives data that you are assessing, how are you viewing this one, and what would you do with HDFC Bank?
Yes, the opening below 1600 mark is definitely not a good opening, because we have opened below the major averages. So this is one big negative. And the last time when we had this kind of decline in September 2023, we had a decent phase of normal but yet gradual distribution in the stock. So again, it might like 1530 is the immediate support that we have on the weekly charts, and below that again 1450. So broadly, if you see that again, we have not made any progress when it comes to the price-wise move in the SDFC. It's still the upper band exists around 1700 mark, which it tested shortly. And again, now we are inching towards the lower band, which is around 1450. So broadly, this range will continue to play out. And as I've said that there could be a marginal breather around 1530 area. But don't look for aggressive long until we reclaim 1600 mark if you are a short-term trader.
Okay. Dhwani, would you concur? Do you think that HDFC has, do you think there's consolidation on the charts, or do you think there could be more weakness here?
No, absolutely. I agree with what he has said right now, that HDFC definitely is looking weaker on the charts from the current levels. Weekly chart is definitely interesting for me over here, because today what we are seeing as on the weekly counter is that it's breaching all the important moving averages on the lower side. The consolidation that we were seeing was from 1700 to 1430 to 1430 mark. And currently also, I definitely agree with the point that yes, so we will be seeing further weakness coming in. I am not pretty sure about 1530 acting out over here as a good support level. For me, the next level that I am looking up at is 1430.
Okay, that's a view on HDFC Bank. And for now, of course, we must also remember that before the earnings last Monday, we saw a significant amount of build up in the 1700 strike. It's very clear now that perhaps there were traders who were betting against HDFC, at least reacting positively to its earnings. At one point in time, in fact, we even saw HDFC moved somewhere close to the mark of 1685, 1690 levels. But you know, that open interest concentration around the 1700 mark had not changed. There was no change there. And it seems like those who had written those specific 1700 calls on the HDFC are certainly, well, laughing their way to the bank at the moment, considering HDFC Bank has now moved below the mark of 1600. And speaking of 1600, there will also have been plenty of traders who would have written that particular put with not expecting as sharp a reaction on HDFC Bank as the one we're getting today. Well, it is those writers who have written the 1600 put, well, run for cover at the moment, and hence a little bit of the precipitation is also on account of that longs unwinding coming through. Well, that's as far as HDFC Bank is concerned. But on that note, we slip into a short break, but on the other side, we talk about stocks and a lot more. Stay tuned. Welcome back. This is the F&O Show, and we now shift focus to all the stocks which are seeing a substantial increase and a decrease in open interest. Let's start with those which are seeing an increase in positioning. So we will, of course, have a handful of counters. HDFC Bank is right at the top of that list, even as it moves down by 6.5% and 13% added in open interest towards shorts. Sale is the other one, declining by about 3.7%, pardon me, and that's where we're seeing increase towards shorts. Kotak Mahindra Bank is losing out around 2.6%, and now that one also moves below the mark of 1,800 rupees per share. Are market participants casting a shadow on a whole host of other banks? That's the question, really. And we're seeing longs unwinding in Nelco, Bajaj Finance, Torrent, Pharma, along with Berger Paints. All of these counters are under pressure. The question is, what do we do with these stocks? Ajit, I'll come back to you on this one. Stock ideas that you have on your radar at the moment.
So among the names that you just shared, Agam, Kotak definitely looks weak to us, considering that HDFC and Kotak, they are among the underperformers within the private banking space. And we feel that this breakdown below 1,800 mark now, plus it has slipped below the major averages, just in line with what we were seeing in HDFC, though the quantum is still less. We feel that the kind of attempt that we were seeing for recovery would subside again, and decline below 1780 might push the stock further lower towards 1720, 1700 levels. So there is one stock that one should look for shorting opportunities with 1820 as a stop. And other than that, we have two recommendations for the day. The first one on the list, we have TCS. So IT, the overhang of the results are over, and we feel that the kind of buoyancy that we are seeing in the IT pack, there's a possibility that TCS will continue to do well from the current level. So one can look for buying opportunity in TCS at current levels, with 38 to 55 being the stop and 4010 as a target area. At the same time, we are seeing distribution breakdown in Ramco Cement. It's almost like 2 months of consolidation breakdown. So 940, 935 is what we are eyeing as the immediate target in Ramco, with stop at 992.
Okay. Well, incidentally, Ramco is also on the radar of Dhwani. Dhwani, I believe there's Ramco and also Nelco. Can you tell us, can you take us through your views here?
Yes, absolutely. Ramco is also one of the counters that I have picked up. I'm going short on Ramco from the current level. We are already seeing some breakdown coming in on this particular counter. The weakness over here in this counter would continue till 950, and the next target that I have on my radar is 938. The stop loss that ideally one can maintain over here is of 995. The next counter that I have is that apart from the banking, we are also seeing some profit taking coming in the metal sector as well. We are seeing some profit cut coming over here in SAIL, in Jindal Steel, in Nelco. So Nelco is the one which I've picked up from this entire pack. I see Nelco showing weakness till 130 to 128 as a target, and the stop loss to ideally maintain over here is of 138.
Okay. All right. So those are two more trading ideas. Well, let's pull up once again the Bank Nifty specifically and the constituents of the Bank Nifty, and see where there is some sort of short build-up, perhaps a long, or pardon me, some longs unwinding there. When it comes to the Bank Nifty constituents, and there you have it. That's the chart I'm looking for. So take a look at ICICI Bank. So the shorts building up there. Axis Bank is looking at shorts to the tune of nearly 3.8%. SPI is looking at a decline of around 1.5%, as we see about a 1.5% increase in open interest. Kotak Mahindra Bank is something that we've addressed. We have IndusInd Bank, and well, I believe out of the 12 constituents, we are looking at shorts in about 9 to 10, companies out there. So the banking index is certainly looking a lot weaker at the moment as we speak. And even the relatively smaller ones, something like an IDFC First or a Federal Bank or an AU Small Finance Bank, is all looking at a significant build-up as far as open interest is concerned. So there certainly is a lot of weakness of late. But on the flip side, what we are also looking at is gains in the oil and gas space. So I do want to address, and Possibly not today, but I do want to address what's happening with something like a BPCL for that matter, because that's where it's marginally in the green for now. But the question really is that are there more legs to the rally? Because we've had a little bit of a consensus of positivity as far as BPCL is concerned. Let's take this up with our experts. Dhwani, if you are tracking BPCL, your view here, and would you perhaps balance your short calls with a long on BPCL?
Agam, BPCL over here, I'm definitely seeing that we are seeing that the 460 mark was taken out in yesterday's session, and we are seeing some up moves coming in on this particular counter. But I do see a close by resistance coming it at 480 to 482 mark. Rather than BPCL, I would like to go for GAIL in this particular entire pack. GAIL is definitely showing strength over here, and we've got a fresh breakout coming in this particular counter. So GAIL is the one which I would like to go into the buy recommendation side, and from current levels, I'm expecting the next upward target over here of 172 coming in on this counter with a stop loss on the lower side at 164.
Okay, there you have it. That's your view on a handful of oil and gas names. But we are out of time, so I'm going to take a moment to thank both our experts, Dhwani and Ajit, for joining us and taking us through their views on the markets and also giving us a handful of trading ideas. And we wrap, but before that, ICICI Lombard's third quarter profit jumped 22% and fell short of analyst expectations. We spoke to the management on the company's motor segment and their loss ratio. Take a look.
If you look at new vehicle sales across categories, whether it is private car, whether it is two-wheeler, or for the matter of fact, commercial vehicles, I think we are seeing a lot of positive momentum getting played out. A lot of it is also to do within the context of the festive demand as well as rural pickups. So across the three categories, insofar as the market momentum is concerned, that's looking very, very positive. That's why, as a part of our earnings call last evening, we had also kind of put out what has been the new vehicle volume sales that one has seen insofar as the market is concerned. So hence, in that sense, I think the demand momentum seems to be looking very, very positive. Now, let me put it in the context of how the insurance industry has been kind of also responding insofar as motor as a segment is concerned. Directionally, if you see, while the combined ratio still stands elevated, but definitely it is kind of 4 to 6% better than what combined ratios that the market has been operating, let's say, 1 year back. So again, even from a market perspective, I think there seems to be a sign of semblance that is kind of possibly getting played out, and hence, which is where the directional change for improvement in combined ratios is also getting exhibited insofar as the insurance market is concerned. And within that, now when I talk in the context of ICICI Lombard, our approach to writing risk, whether it is for motor or whether it is for any other category of businesses, we have always chosen to drive profitable growth as a theme. And what we effectively try doing as a part of this theme is whenever we see opportunities of growth, we obviously kind of significantly deliver better growth momentum. But at the same time, when we, as I said, maybe for a couple of years, when the market has been at elevated levels of competitive intensity, we have always been a bit guarded/cautious. So it is in that context is where maybe for the last couple of years, we have been growing a shade lower than insofar as the market growth is concerned, particularly in the context of motor. But what we are very happy in the context of ICICI Lombard is if you look at the relative gap between what was existing as industry growth numbers in motor and ICICI Lombard growth numbers in motor, that has been significantly coming off over the last, I would say, pretty much on a sequential basis, quarter on quarter. For the half year, for example, the gap between industry numbers and Lombard numbers were about 8%. But for quarter three, that gap is down to less than 4%. And for the month of December, we actually have kind of outgrown the market. So hence, I think we are very, very positive and optimistic in the way how one is seeing the growth momentum play out in motor as a category. And for ICICI Lombard, I think we are rightly positioned to capitalize that opportunity for growth. In the context of loss ratios, I think on motor, I think again, we are quite comfortable at the loss ratio ranges that you are seeing for us on 9 months, which for the segment has been at an aggregate at about 65%. I think the range that we have generally spoken to the market is comfortable in the range of 65 to 67%. So at this point of time, I think whatever we are seeing on the loss ratio trends, from an ICICI Lombard standpoint, I think we are quite comfortable at the range at which we are operating at.
Hello and welcome. You're tuned into the Small and Mid Cap Show. I'm Hiral Dadia. Let's quickly take a look how markets are panning at this hour. Overall, with the way HDFC Bank numbers have panned out, which has a good weightage in terms of Nifty as well as Bank Nifty, that's something which is having a bearing as well, and you're seeing a profit booking coming in there. If let's pull up Nifty 50 as well, we're seeing cuts on that front. Bank Nifty is down over 3%, mainly on the way HDFC has been. You see Nifty as well. 21,750 is where we are trading at currently. Taking into consideration the components as well, let's pull up the movers and shakers and the top gainers on Nifty 50, because the advanced decline ratio is absolutely in favor of the declines. And if you see in terms of the contribution, HDFC Bank is pulling the Nifty low by almost 180 points followed by ICICI Bank, Kotak Mahindra Bank, as well as the Axis Bank as well. So clearly, it's the private banking space which has been under pressure. Infosys is holding strong. TCS is also holding strong in today's day of trade. HCL Tech is seeing some good moves. Coal India in the positive. And you have a L&T which is trading in the positive. We've already spoken about Bank Nifty, but let's just pull up the Bank Nifty components as well, because you already have the private banking space which is under pressure. In fact, 12 declines in terms of Bank Nifty. Not a single banking counter which is in the positive on that front. HDFC 6.5%, AU Bank, Kotak, Bandhan, and a Federal. In fact, Federal also reported earnings in yesterday's session during market hours. Now the stock is down a little over 2%. Let's look at broader markets as well and see what's happening on that front. If you can pull up the mid-cap as well as the small-cap index and see. There you go, 0.5% cut, but clearly you have some bit of outperformance coming in from the broader markets vis-a-vis what's happening in terms of benchmark indices. Even the Nifty small cap index is seeing cuts of around 0.4%. Overall, if you see in terms of stock-specific action, Network 18, that stock is up little. It's locked in upper circuit 10%, and this is on the back of news reports indicating about Book My Show. Seeing some investments as well. Apart from that, Cochin Shipyard is seeing gains of 9%. Midani is up around 7%. MSTC, that's an interesting one as well. 7 to 8% is the kind of gains that we're seeing on this counter. On the losing end, you have IEX, which is trading under pressure. Zomato is down in trade. Loda and Prestige, both these counters from the real estate pack, are also trading under pressure. So that's how the markets are looking like. But let's shift focus in terms of earnings. Now you have MapmyIndia. That stock is in focus as well. The company did report numbers. Now clearly, if you talk about the profitability, margins all have declined, and this is on a sequential basis as well. In fact, overall, if you see from an earnings perspective, the guidance what they've given is 1,000 crores plus by FY27 or 28, which is a 35 to 40% CAGR growth. In fact, my colleague Alex Matthew is in conversation with the management. Let's hear them out. Alex, over to you.
Thanks, Hiral. Well, we're in conversation, as you said, with the management of MapmyIndia, and we're joined by Rohan Verma, the Chief Executive Officer and ED of MapmyIndia. Rohan, thanks so much for taking the time. Let's delve straight into the numbers. 36% on-year growth in the top line, 1% sequential. If you can break that down for us and tell us what contributed to this number.
Sure. Thanks a lot for having me. And the right way to look at MapmyIndia's business is always year-to-date, year-on-year. Quarterly numbers can move here and there because it's a B2B business with various natures of contracts. We've been having a pretty strong open order book, and the revenue growth is broad-based across both automotive and mobility tech, as well as consumer tech and enterprise digital transformations, meaning that a lot more vehicles, four-wheelers and two-wheelers, and even now commercial vehicles are coming built in with our solutions from the factory, as well as in the aftermarket. Fleets are adopting our solutions, or even consumer-facing companies or enterprises across the private and public sector, new age tech companies are adopting more of our map and IoT solutions. So we're quite happy that this quarter we've crossed this 100 crore total income milestone, 92 crore, an all-time high of revenue, growing 36% year on year.
Understood. So I was just looking at the CNE, and you were pointing that out, right? Consumer tech and enterprise digital transformation growth of about 71% year on year. I'm just trying to understand the mix as it stands right now and whether or not that is shifting. Obviously, it's primarily B2B, but within that, how is it moving?
Sure. These are fairly independent vectors in the sense that the automotive and mobility tech TAM that we have is one side, and consumer tech and enterprise digital transformation is all the large enterprises that can adopt our solutions, and A&M is all the vehicles that can adopt our solutions. So fairly independent. Quarter on quarter, there is variation in the growth, but as a mix overall, this is kind of split approximately half.
Okay, understood. So as I understand it, heading into FY28, over the course of the next 3 years, we're looking at a CAGR of around 35% for the top line. Is that fair to assume?
That's right. What we've put out is our aspiration and our goal that we're working towards crossing a milestone of 1,000 crores by FY27, FY28, and that translates into a 35 to 40% CAGR if you look at it. But overall, for us, the objective is how do we position the company well, and we are well on our way with a pretty large open order book towards achieving that number in that time frame.
What is the size of the order book as things stand right now?
We declare these numbers annually because annual new order bookings make sense when it comes to B2B business. And so we ended the year at 900 plus crore open order book FY23. And we're quite excited by the order book build-up that we have already. There's a few large wins that we will announce shortly as they develop. So in that sense, we've surpassed kind of new order bookings. Quite excited about that, and Q4 will hold some good news for us.
Okay, look forward to hearing from you. Speaking of opportunities, some of the players in the market that are in similar spaces are talking about opportunities in Ayodhya. Now, I think a lot of attention is going towards that. Do you think that you stand to gain as well? Is there something in the works?
See, MapmyIndia solutions are there in the market. We are winning business. We're a products and platforms company. We're not, unlike some other players, in services or professional services. And of course, we're not in the early stage as they are in just doing freebies and announcements rather than products and business on ground. When it comes to Ayodhya and UP Tourism, in fact, we've already won business for our metaverse solutions, which is digital twin-like, as well as for tourism-based solutions. And in general, through our consumer app, Mappls app, as well as our traffic management solutions that we work with UP Police, we're already doing a lot of work in UP Police, but we tend to focus on real business that we've achieved, quarter on quarter.
Okay. When I look at the margin front, I see that there is a contraction both sequentially as well as year on year. Sequentially, that is pretty sharp, 585 basis points or thereabouts. But there's even a year on year basis, there's a 206 odd basis points contraction. Is that par for the course? As I understand, that's on account of an increase in cost. Where is that coming from?
Sure. We've always said that, look, in FY24, our EBITDA margins will be 40% plus. So if you look at on a 9-month basis, year to date, actually EBITDA margins have expanded to 43% from 42% last year. Quarter on quarter variation will be there. So we have enough buffer for a 40% plus kind of EBITDA margin aspiration. PAT is also a healthy margin of 32, 33%. Year to date, year on year. So we're quite happy with the profitability numbers. We've hit 116 crores of EBITDA margin year to date. And as you said rightly, EBITDA is affected by marketing that we wanted to do. That's one thing. And we've been pretty cost effective, but cost efficient yet effective in doing ATL and BTL for the MapmyIndia brand, as well as the Mappls app, which is doing quite well in terms of traction and brand awareness. And hopefully everybody is seeing those results in terms of awareness and adoption. So in that sense, this is planned, this is calibrated. EBITDA margins are strong, PAT margins are strong. And EBITDA growth and PAT growth is also quite strong year on year.
Okay, so steady state above 40% is achievable from your answer. I take that as well. There's an approval from the board to raise 500 crore via QIP. When do you anticipate that will come through in this financial year itself? And what is it going to be used for?
Sure. Shareholder approval has also come in as of end of December. It was voted quite strongly in terms of 99.2% votes towards this resolution. In general, as a company, we've been pretty visionary, I would say, pioneering in building deep tech digital products and platforms. We're obviously going easily toe-to-toe in many cases, surpassing the global tech giants. I think that's something to be proud of as Make in India. But always we've planned beyond just 4-5 years. 4-5 years goals we have laid out last year in our investor presentation. But beyond those 4-5 years, as we look at to international market expansion, as we look at the development of our drone business, where already we are playing a serious role, as well as growth in the consumer business, which opens up a whole new optionality. We want to be well prepared and resourced to be able to deliver on those things as well. So in terms of time frame, I can't tell you the time frame. This is a planned process, not right for me to comment on that. But in terms of kind of, the potential for the business beyond the core B2B India-centric business that we have for maps and IoT, I think there's lots of growth ahead, and that's what's exciting for us, and that's what we're executing on.
Okay, fair point. And you can't give me any indication as to whether it's going to be a fundraise this year or next?
I'm sure at the right time we'll be able to, file the required disclosures to the stock exchange, and,
sure.
and hence at that time be able to talk about these things.
Fair point. All right, Rohan, thank you so much for joining in and for giving us the perspective that you did. And thanks so much for speaking to NDTV Profit.
Thank you very much.
Back to you, Hiral, in the studio.
Thanks, Alex, for getting us this exciting conversation, because with Ayodhya coming in as well, a lot of order flows that are coming in for companies like a MapmyIndia, and one of their closest competitors is Genesis. Let's just pull up the chart of Genesis and see what that stock is doing in trade. It's a smaller name as compared to a MapmyIndia, but there you go. That stock is up almost 3.5% in trade around the buzz of Ayodhya and with regards to the temple on the 22nd. But let's quickly slip into a short break. We'll be right back to talk to the management of Nelco about their third quarter numbers. Company's managing director and CEO, PJ Nath, will be joining in. Please stay tuned. Welcome back. You're watching the Small and Mid-Cap Show. Let's pull up a Nelco on the screens and see what the company is doing in trade post their numbers as well. The stock is down nearly 1.5% as we speak. Clearly, the margins have seen a dip, and that's mainly on the back of a higher employee expense, as well as the change in inventory that we've seen. Revenues up around 12%. If you talk about the profitability as well, that has gone up around 23%. But let's welcome in the management and understand the breakup so far. Mr. PJ Nath, MD and CEO of Nelco, joins in. Mr. Nath, good morning and welcome to the show. And my first question coming to you is, have the numbers met your internal expectations?
The numbers are good. We are happy with what we are doing. Of course, we want to do more than that, but we are definitely satisfied with what has happened in the last quarter, both in terms of the revenue growth as well as the profit growth that we've seen sequentially as well as over the last year. And it's been very healthy for us. Our overall debt equity ratio has gone down to 0.2. Our debt has gone down to 23 crore, which is the lowest for us so far. So overall, the company has become fairly healthy, and we expect to therefore see much better growth going forward.
Right. So in terms of the debt that you mentioned as well, the lowest in history that you've seen at 23 odd crores, is that going to be a comfortable number, or you think how soon will you become debt free?
We believe that our this 23 crores is not the last. We'll go down below that as well. I would not like to comment at the moment in terms of when we become debt free, but our debts will certainly go down as we go forward in the current quarter.
Right, but my question was, is the plan to become debt free?
Well, there are a lot of new investments we'll be making because of new satellite capacities coming. There will be new teleports will be opening up, and therefore it is we will also be investing in that. And therefore, the main objective is not to necessarily become debt free, but it is certainly to become more efficient so that we reduce our debt and yet manage our growth that we'll be having going forward.
Right. Overall, if you see in terms of the business as well, where are you seeing the opportunities emerge now for the company?
We are present in all the three segments, which is enterprise, which maritime, as well as aircraft communication. We see growth in all the three segments. Now, there are timing issues. For the aircraft communication, the time could be slightly later because it takes after more time to get the aircraft equipped for getting connected on for satellite communication. Maritime, we've already seen fair amount of growth. Enterprise has been is a big story. There are multiple segments within that. Some of the segments have not grown the way we expected it to grow so far, but going forward, we see them to be growing. So overall, therefore, we see all enterprise, maritime, as well as aircraft communication to be growing over the years. But immediately in this particular quarter, we will see both enterprise and maritime communication growing.
Right. So if you're saying enterprise and maritime communication are going to be the growth drivers in the coming quarters as well, what's the revenue contribution you're expecting from these two segments? Do you expect that mix to change?
Yeah, currently our in-flight and maritime communication is about 27% of the total revenue. It'll be around that because while the enterprise is growing, maritime is also will be growing. So overall, our in-flight and maritime communication will be in the range of 26 to 27% the total revenue going forward in this particular quarter.
Right. And what's the current order book overall?
We don't specifically talk of any order book because of our business is more in terms of annuity contracts as well as new projects that we have. We focus on getting more annuity contracts so that our base is strong and growing. So suffice to say that we've got enough contracts with us to give us the kind of growth that we've seen this quarter going forward as well.
Okay. And in terms of the Indian space sector, which has been identified as a growth driver as well by the government, what is the role that a company like yours will have, and how are you looking at growing this space as well?
Yeah, we are a satellite communication service provider. We are the ones who offer the end-to-end service to our customers. So far, we are focusing more into the enterprise customers, the maritime communication, and in-flight communication. We see all the three sectors to be growing, and we will be playing a very important role as an industry in terms of offering the end customer service, service to the end customers. So that's where we'll be. We will be seeing a lot of change in terms of the kind of satellite being launched, and therefore the type of satellite capacities being available, and the price at which we can will get them, which will obviously come down, because of which satellite communication service will be more affordable for the end customer, then therefore that will grow further. So we will be playing this very important role in terms of ultimately touching the end customer in terms of the satellite communication services. So that's where we'll be.
Okay. And overall, Mr. Nath, if you have to look at even the Indian aviation sector, right? You're talking about in-flight connectivity services. Any talks that you already have ongoing, and how long do you think will it take to actually scale up that part of the business?
We are in talks. First, let me give the perspective that even in the aircraft communication service, Aero IFC as we call it, we've been growing. It's just that our growth so far has been more with respect to international aircraft flying over India. We are in touch. We are in talks with the domestic airlines operators as well for offering the service in the domestic routes. We believe that it will take about a year and a half for it to get started. There are different discussions happening in terms of the business model, the business case, what kind of services could be offered, et cetera, et cetera. So I think that's where it is. So we believe that that will happen in about a year to year and a half's time.
Okay. The recent acquisition or investment that you've made as well with regards to where PISS Networks is concerned, I hope I'm pronouncing it correctly. What's the status of that, and how is that going to contribute to overall Nelco's business?
Okay, let me give a perspective. We are a satellite communication service provider, which means we offer an end-to-end service, connectivity service to our customers using a satellite spectrum. Now, we have also felt a need in the market that apart from satellite communication, the customers would also want to have another media for different reasons, for sometimes for backup, sometimes for redundancy, etc. And to do that, we require what we call as a software-defined modem or SD-WAN. So we have the option of buying SD-WAN from various vendors which are available globally and offer it as an end-to-end service to our customer, or have a product of our own. But because we are not a OEM ourselves, we are a service provider, and therefore we invested in this company. You pronounce it right, it's called PISS. That's a very innovative company. It is a startup, but has developed a very good solution, very good product, which caters to the needs of our customer. And therefore, we are able to offer a solution to our customer, which is combination of satellite communication as well as either a 4G or a broadband. So that is what we have done. And we've invested 30% in that company. And this has also given a lot of confidence to our customers that we are serious about this business. And then we see good prospects because of this overall investment that we've done in this SD-WAN company.
Right. Mr. Nath, overall, what's the kind of growth that you're looking at in terms of FY24 and 25 then, with all the levers in play? And what's the key milestone that the company wants to achieve?
In terms of milestones, one of our major focus of the company has been to become profitable, or rather increasing our profits, becoming healthier by balance sheet, reducing our borrowings, etc., which we are achieving. In terms of revenue also, while on a YTD basis, we've grown only 3% from a 9-month perspective. But the important part is that our service revenue within that has grown by 13%. So therefore, our service revenue part has been growing, and that is the trend. So while I'll not give a specific number for what will be at the end of the year, but we'll certainly be a double-digit growth over last year in terms of revenue. And profits will be at a similar kind of growth that you've seen currently, which is more than 20%, either sequential or year-on or an annual basis.
Right. So I think that's a good guidance that one should be working with as well. Thank you, Mr. Nath, so much for joining us on the show and speaking to us at NDTV Profit. So that's the management of Nelco. The stock has been slightly under pressure as we speak in today's day of trade, but completely out of time. But that, it's a wrap on this edition of the Small and Mid Cap Show. Lots more lined up on the other side. Please stay tuned to NDTV Profit.